everybody, welcome back to Tim Travels. It's Terry, your host, back on the road after spending a few days home for Thanksgiving. Came back out on Monday. Came out on Monday. Picked up a load in, where the heck was that? Oh yeah, in Morgantown, PA. Took it out to Kansas. Picked up another load just down the road in Kansas, in the Kansas City area. And that load I'm delivering tomorrow morning in Florence, Kentucky. So on my way out to Kansas, I went through, because a lot of stuff's been on my mind, and I've been reading a lot. And I went through Indianapolis, and I got to tell you, it was kind of emotional for me because I went by the Lucas Oil Stadium, and I shed a little tear. You know, I had a few tears in my eyes because I was thinking of the Colts owner, Jim Irsay, and how he's totally sticking up for white billionaires. He had an interview recently where he talked about being victimized because when he got arrested for DUI and having a bunch of drugs and stuff in his car a few years ago. But he's like, look, I was arrested only because I'm a white billionaire. And so I want to give a shout out to Jim Irsay for carrying the water for white billionaires, because if any group of people needs somebody looking out for them, it's white billionaires. So there's that, and I'm not going to do any history right now, although yesterday was my wife's birthday, so I told her that happy birthday yesterday, but I'll just mention that. And I was, I'm kind of pro-union, and I think people have probably deduced that from watching my channel over the past couple years. And one of the things that I think is amazing, somebody that I think is amazing, is a guy named Shawn Fain. And Shawn Fain is the president of the United Auto Workers. And he came in for a lot of criticism from corporate America because when he was negotiating with the big three U.S. automakers, Stellantis, again, I still don't like the name, General Motors and Ford, they were all like, oh, we're suffering, the economy's this, inflation's up, we got all these pressures. And Fain was like, sucks to be you, but we're not going to get paid what we're, not worth. Maybe I didn't say that right. We're going to get paid what we're worth, basically. And we're going to get benefits, and we're going to guarantee our job security going forward. And he kept tightening the vice on them, which is kind of apropos because he's a blue-collar guy. He's not, he was just at a local level and decided he thought that the leadership of the UAW was too cozy with the corporate overlords. And he ran for the position, and I think everybody in the UAW that voted for him is grateful that they did, because he kept tightening the screws. And he knew the pressure points. He knew that shutting down the assembly, Ford assembly line in Louisville was going to be a good way, because that's where they made the F-150 pickup trucks. And he knew that shutting down the GM assembly plant, I think in Arlington, Texas, where they make Suburbans and Escalades, that was going to be a pressure point, because those are high volume, high profit businesses. And he really did a great job. And here's why I say that. I don't care what all those companies said about the UAW and their demands. GM just announced, this is like a couple of weeks removed, 3 weeks removed from saying how bad things were. And by the way, Fain was like, look, your Q3 revenue was really high. And they're like, yeah, but we got costs. It's revenue. What about our profits? GM just announced, Mary Barra, who's the CEO of GM, just announced yesterday $10 billion stock buyback, as well as an increase to the annual dividend that GM pays on its stock to its stockholders. And just so you understand what a stock buyback means, it means that the company thinks their stock is undervalued in the marketplace, in this what is called the secondary market. So they're actually buying their own stock because they think it's a good deal. And as it comes off the market, they increase their they decrease their public float, and it drives up the stock price, which benefits anybody that owns GM stock, including most of the executives. So much for GM having cash flow problems. Speaking of GM, and I'm going to do a different episode on this, but I did want to mention that the Cruise self-driving or autonomous taxi cabs in San Francisco have basically been pulled off the market, and GM was a big supporter to the tune of several billion, I think $3 billion into Cruise. And the interesting thing is, I was thinking about this when my truck was trying to tell me the speed limit on I-64 going through, I think like Wentzville, Missouri a little bit ago was 20 miles an hour. And I was thinking about these autonomous vehicles and what's going on, and we'll talk about that. And Aurora, who's a company that's now starting autonomous routes between like Dallas and Houston. Why, I know not, because that's probably one of the corridors I would least like to drive. I-45 is just, to me, dangerous, especially down around the Houston area. But whatever, that's what they're doing. So I'll talk about that later. But I wanted to talk today about money and making money and being safe with your money. And this might be a little bit of a stream of consciousness, but I wanted to talk about it because a friend of mine called me, and he was like, hey man, we were talking about stocks, and we often talk about that, and he was talking about some of the investments he made and how he had invested in some AI plays and you know, some of the other stuff he was doing. And one of the things he said is he kind of pays attention to what Warren Buffett does with Berkshire Hathaway. And by the way, rest in peace to Charlie Munger. Charlie Munger was 99 years old. Charlie Munger is, if you don't know who he is or was Warren Buffett's right-hand man. He's the even older dude that you see sitting beside Warren Buffett at the Berkshire Hathaway shareholder meetings and stuff. But one of the things that Berkshire Hathaway has done over the years is they've essentially invested, they're an investment company, okay? And they buy stock in companies that they think are undervalued and wait for the stock to go up. But one of the big things that helps the valuation of Berkshire Hathaway itself is dividends. And let me just take a little quick sidebar here into the trucking industry for a second, because I don't know if you've paid any attention, but Berkshire Hathaway, Warren Buffett's company, owns a huge stake in Pilot Flying J. Now, the company is controlled by the Haslams, who also own the Cleveland Browns, so that'll tell you where their head is at. But they gave Deshaun Watson a guaranteed, $800 billion contract when no one else in the industry would have. But anyway, the Haslams are pissed at Warren Buffett and Berkshire Hathaway. And the reason they're pissed, and I think they've actually filed a lawsuit, is because what happens is Berkshire Hathaway, because they're a publicly traded company, they place a value on the assets that they hold when they file their quarterly and annual reports. And turns out that Berkshire Hathaway values the Pilot Flying J stake that they own at significantly less than what the Haslams think the company is worth. And now it's come out that some people in the Haslam camp tried to bribe some people at Berkshire Hathaway to get them to increase what they said in their public reports they thought Pilot Flying J, their stake in Pilot Flying J was worth. The reason this is important, not the bribery, I mean that's a crime, but the reason it's important is because the Haslams, unless I miss my guess, are leveraged against their own equity position. So in other words, and by the way, this is the exact same stuff that Donald Trump is on, his companies are on trial for in New York. The Haslams, they're saying, oh, and I'll just pick a round number. They'll say, hey, our stake in Pilot Flying J is worth $1 billion. But Warren Buffett buys, $1 billion of equity. And then he's like, now, wait a minute. This equity is only worth $730 million. And so as soon as he says, let's say that he bought what was priced at $1 billion, he says, oh, it's only worth, but it's not worth $10 a share. It's only worth $7.30 a share. That devalues everything that the Haslams hold. But Warren Buffett has butt tons of credibility in the markets. And I'm sure that any bank that loaned based on $10 a share that was represented by somebody, then later on has the Oracle of Omaha saying, yeah, that's only worth 73% of what they told you it was. That would get some people's interest. So that's an interesting little aside. But getting back to the dividends, Warren Buffett tends to buy stocks that are either undervalued or that are going to generate income. And that's really what I want to talk about today. So I want you to think about a couple of things. And if you know anything about the stock market, there's the Dow Industrial, 30 industrial stocks. It's weighted. And then, but the bigger market, the S&P 500 and the NASDAQ also is a lot of tech stocks and stuff. But a lot of people look at the S&P 500 as a broader market benchmark. And the S&P 500 has been around for a long time. S&P stands for Standard & Poor's. But what I did is I went back and I looked at the total return of the S&P 500 over decades. And one of the things that came out, and let me just back up and say, if you don't understand what a dividend is, it's basically I guess I would call it the functional equivalent of interest based on your stock holdings. So for example, let's say I buy a share of Berkshire Hathaway, and let's say that I paid $100 for that share, but their dividend yield was 3%. What that would mean is that and let's say that the value of the stock never changed, it was just always $100. That means that every year I would get either $3 cash or I would get $3 more of Berkshire Hathaway stock. So what it has the ability to do is appreciate your position, enlarge the position, meaning how much stock you hold. But let's say that the price of, but here's the difference between interest rate of 3% and dividend yield of 3%. Suppose if for a moment that the Berkshire Hathaway stock in the open market dropped to $50 a share. The dividend, even though the yield is expressed in a percentage, it's going to be a cash value. So they would say our annual dividend is $3 a share. Well, at $100 a share, that's a 3% dividend. But if the stock price drops to $50 a share, then the dividend yield, not the dollar amount, but the dividend yield is now 6%. Conversely, if the stock goes up to $200 a share, then the dividend yield is cut in half because the stock price doubled, so the dividend yield would be 1.5%. So now that I've kind of quickly explained that, I want to share with you why I'm a huge fan of dividends. And one of the things, so I told you that over time, right, or maybe I didn't tell you that, but I looked at the S&P 500, and over decades, so, the past, let's say, 70 years, 41% of the gain in the S&P 500 is based on dividend yield. Because what has happened is over that time, all these companies, and about 80% of the companies in the S&P 500 pay a dividend of some type. There are what they call dividend aristocrats, and if you go to S&P's website, you could look up dividend aristocrats. But the dividend aristocrats are 66 companies that have never lowered their dividend. They've always kept it the same or raised it, and that's even better. But what you start to see is situations where, like Berkshire Hathaway, because of dividends, even if nobody's stock price went up, they're still making hundreds of millions of dollars a year in dividend cash. And they probably do take their dividends as cash because they want cash that they can use to make other investments. So let's say that they own, 10 million shares of Coca-Cola. And by the way, Buffett has a huge position in Coke, ticker symbol KO. Let's say that they own, 10 million shares. That 10 million shares is probably throwing off, I don't know. I should know what their dividend yield is because I own Coke stock too. But let's say it's 3%. So $10 million, that 10 million shares is throwing off $300,000 of income a year. Now, I'm pretty sure that, I think that's right. Yeah. I'm pretty sure they own more than that, but you get my point. And even a lot of tech companies like Microsoft, Intel, Apple, they're so big now that they're mainstream industrial companies that pay dividends. They're past their growth stage. I mentioned kind of at the top, one of my friends kind of took a beating on some AI stocks, right? AI stocks, they're growth stocks. They're very speculative, but they have the potential to go through the roof. The problem with growth stocks is that you have to be paying attention to your portfolio all the time. And you have to understand that when you execute trades, even if you're using some really fast brokerage house to do your trades, if you're driving your truck down the road and you don't have like a stop limit order or some other kind of hedge, some kind of option on that position, you can lose your shirt in a couple of hours. You could have bought 10 shares at $100 and that stock could go to like $30 while you're driving between, Memphis and Little Rock. But the dividend stocks, and I'm going to take just to give you a little bit more insight into this. I want you to take a look at this chart. And I pulled this chart off of, this is from The Hartford. So big insurance company, but also financial services company. But look at this chart. So what that chart shows you is what the S&P 500 did from 1960 to 2022. without dividends and without the reinvestment of dividends, you would have, if you put in like $1,000, you would have $641,000 in 2020. But if you'd reinvested everything, all the dividends, you would have over $4 million. And if you look really closely, I don't know if you'll be able to see it, but you actually, there was a point where it was about 5 million. And that's what, it's slow and steady wins the race. When I was a financial advisor, I worked for a huge insurance company and financial services company. One of the things that we constantly preached to our clients was that conservative investing was the real way to wealth. Sure, if you are super wealthy and you have, like Jim Irsay, you have billions, and I don't know how much of that is in cash, but if you have, let's say you got $1 million cash to play around with, you can take a flyer on some AI stock or some emerging technology or some biotech company. You can say, oh, I'm going to buy 100 shares of this at $100 a share, or I'm going to buy 1,000 shares at $10 a share. And then if that thing doubles in value or triples or quadruples, you're going to make a mint. But you could also lose your shirt too. And if you got money to play around with, you can do these things. But if you can't really afford to lose money because you're just starting out, like a lot of people are, then investing in blue chip dividend paying stocks is going to be the way to start and to establish wealth over time. And let me give you some examples. And I've told this story to people. I don't know if I've ever said it on my channel, but I was a financial advisor back in 2008. I still have my law license, still did legal work, but my primary function, I was a financial advisor, had all my securities licenses. I remember talking to somebody who was panicked about the market. And my comment to them was, hey, 3 months ago, McDonald's stock was at like $98 a share. Today it's like $62. So that it lost about a third of its value. And I said, but I said, have you gone by a McDonald's today or in the last week? Yeah, the answer was. I said, are the lines any shorter at McDonald's? No. Why is that? Because it doesn't matter what the economy's doing, people are still going to go to McDonald's. By the way, McDonald's stock today was like $231 a share or something. I said, if you looked at that investment, you'd be like, oh man, it's in the tank, I got to get rid of it. But that's what everybody else is doing. Why, when I see something like that happen to a company that is a blue chip, can't fail brand. Now, every business can fail, but as long as I've been alive, McDonald's has been selling hamburgers, and it's not going anywhere. And if you look at their performance over my entire lifetime, if you'd have bought $1,000 worth of McDonald's and reinvested the dividends, because by the way, McDonald's pays the dividend, you'd be in Fat City. Another stock I love, I mentioned it earlier, Coca-Cola, the #1 brand in the world. It's the most well-known brand in the world. It's a global company. Now, I drink plenty of Diet Coke, but by the way, there's also Coca-Cola bottlers, people that buy the rights to make Coca-Cola from the parent company Coke. You can buy stock in those companies too. But here's the thing. Don't chase the flavor of the day. Think about what is it that you buy on a daily basis. What is it that you use on a daily basis? You know, another stock, maybe it's not for everybody, and their dividend yield is in the 2s, but it's a stock I like, Union Pacific Railroad. I just saw they're paying a dividend for the 3rd quarter. Union Pacific has paid a dividend for 124 straight years. They never don't pay a dividend. Another company that I like that everybody knows and has an extraordinarily high dividend yield, because I think their stock is beaten down, is Verizon. I think they're in the 7s. Another company, and these are some I own, some I don't. Altria, used to be J.R. Reynolds Tobacco Company. Altria, it's not a stock I own, but they have consistent dividend performance. People are not going to quit smoking. And, you know, if the moral issues around smoking don't bother you, then it's a great stock. 3M Company, I mean, Walmart. I don't own Walmart stock, but it's a good investment. Is Walmart going anywhere? No. I actually think Walmart has the upper hand on Amazon in a way. Walmart pays a dividend. The dividends, what they do for you is they guarantee that every single quarter you're going to own a little bit more of their stock, So you're buying, when you get that dividend, you're buying at whatever the stock is at that point. So I'll give you an example. Union Pacific, I think, is going to close in the 220s today. I've been buying it long enough that I started buying it at like 250, but I've also bought it at less than 200 because I buy it all the time. I buy it every month. So I've bought stock at 190 that contributes to my total holdings, where I get dividends at prices that are higher than what I bought at. And it adds up over time. And you can do a portfolio like this. And by the way, it takes about 5 business days to get money out of an account to use for an emergency. And the thing is, these are marketable securities, and yeah, they could go down, but with the dividends, they're always going to be increasing the amount of holdings you have. And at some point, you can get to the point, and that's what I'm hoping to do after I retire, is do what Warren Buffett does and just say, okay, I'm going to take $1,500 a month or $1,000 a month in dividend or quarter or whatever. So say $3,000 a quarter in just dividend income, and keep the holdings, not sell the core holdings that I have, but just reap the dividends from them. And, you know, over time, if you're in your 20s, 30s, even 40s, you could build up a substantial portfolio that just throws off income, and with companies that are not going anywhere. We're talking huge companies, established brands that have consistently paid dividends. Is Union Pacific Railroad going anywhere? No. Why? Because they haven't, and until we could just like manifest something from A to B, railroads are going to be around. And Union Pacific has the most trackage in North America. They're not going anywhere. Same thing with Coke. Coke is into so many different brands and water and you know, liquid products. They're not going anywhere. They've been around for 100+ years. They're not going anywhere. Is Walmart going anywhere? Not anytime soon. You know, people are always going to want brick and mortar. They're always going to want brick and mortar. That's never not been true. E-commerce is a big deal, but everybody wants brick and mortar. So anyway, I don't know if this is helpful. I hope it is. And I'd be happy to, you know, discuss it. And I'm not going to make like, you know, I probably will do another tutorial, if you will. I don't want to give stock advice. I'm just giving examples here of what I look at, but I may break out some charts and show you the actual metrics that I look at when choosing to buy a stock. And, you know, go over some more of that stuff, go over some, you know, how to use life insurance to accumulate wealth, etc. So anyway, thanks for tuning in. I'll be back. I got to do a review on this Peterbilt truck that I'm driving. Cause I'll get into that. Anyway, it's good to be back on the road. Stay safe out there. There's a lot of crazy weather, and I'll talk to you soon.